For more than 70 years, there's been one book that's pretty much been the Bible for anyone trying to make sense of Wall Street. So today, we're going to break down the core wisdom of Benjamin Graham's masterpiece, The Intelligent Investor. Let's get right into it.
But first, let's start with a question that gets right to the heart of everything Graham taught. I want you to really think about this. Forget about market crashes, forget bad companies, or even crooked CEOs. Who or what is the single biggest threat to your financial success?
And there you have it. Graham's big idea is that the real battle isn't fought on some trading floor. It's fought in the mirror. It's all about taming those gut reactions, right? And honestly, this one insight, it's the foundation for everything else we're going to talk about. So who was this guy, Benjamin Graham? Well, he wasn't just another talking head. He was a total game changer who, right in the wake of the Great Depression, basically decided to turn investing from a guessing game into a real, disciplined profession. And believe me, the guy had the receipts to back it up. Before Graham came along, investing was, it was kind of a mess. It was all gut feelings and rumors. He brought logic to the whole thing, mentoring giants like Warren Buffett along the way. And look, this wasn't just some nice theory he cooked up. His own firm consistently beat the market for 20 years. He really walked the walk. All right, this brings us to Graham's first big lesson. And honestly, this one is critical. He basically said you can't even start to win until you know what game you're actually playing. So you have to ask yourself, are you an investor or are you a speculator? And for Graham, there was a very clear line in the sand. For something to be a real investment, it has to meet 3 tough requirements. First, you have to do your homework. That's the thorough analysis part. Second, it has to promise that you'll get your original money back. That's safety of principle. And third, you should expect a reasonable profit, the adequate return. Anything else, well, no matter how exciting it sounds, it's just speculation. And this chart just lays it all out so perfectly, doesn't it? The investor is focused on how the actual business is doing. The speculator, they're just staring at the stock ticker, watching it wiggle up and down. That's why when the market takes a dive, the speculator freaks out and sells. But the intelligent investor, they lean in and think, looks like there might be a bargain. Okay, so how do you actually master these emotions? Well, Graham gave us this brilliant little story, maybe one of the best analogies in all of finance. He wants us to imagine we have a business partner, a very strange partner named Mr. Market. So picture this. You're in business with this guy, and every single day he shows up, he's a little unstable, super emotional, totally erratic, but he's always there, ready to make you an offer on your business. Some days, he'll kick open the door, just bursting with joy, totally euphoric. He'll tell you your shared business is the greatest thing ever and offer to buy your shares for some absolutely crazy high price. But then, other days, he'll crawl in looking like a total wreck. He's terrified, convinced the sky is falling. And on those days, he'll beg you to take his shares off his hands for practically nothing. And here's the absolute key to the whole story. You don't have to listen to him. You are completely free to just ignore him. Or even better, you can use his wild mood swings to your advantage. You sell to him when he's on top of the world, and you buy from him when he's in the depths of despair. He is your servant, never your master. You are in control. All right, that brings us to the final and maybe the most important piece of the puzzle. This is the core concept that protects you from everything, from bad luck, from your own mistakes, and from Mr. Market's craziness. It's called your margin of safety. And Warren Buffett, Graham's most famous student, had the perfect way of explaining this. He said, look, when you build a bridge, you make sure it can hold, say, 30,000 pounds. But you only ever plan on driving 10,000-pound trucks across it. That huge gap, that's your cushion. That's your margin of safety. And investing should be exactly the same. So what does that look like with a stock? It's actually pretty simple. You do all your research, you crunch the numbers, and you figure out that, fundamentally, this business is worth $1 a share. That's its real intrinsic value, what it's actually worth. But, and this is the important part, you don't pay $1 for it. No, you wait. You wait for Mr. Market to have one of his panic attacks, and you buy it from him for, say, 50 cents. And that gap, that 50 cents between what it's worth and what you paid, that is your margin of safety. It's your buffer. It's your protection. It's pretty much the whole game right there. So as we bring this all together, the most important thing to take away from Graham isn't some super complicated mathematical formula. It's that being a great investor has way more to do with your temperament, with your discipline, than it has to do with your IQ. Really, it all boils down to these 3 core rules. They're simple to understand, but, not always easy to do. First, get your emotions in check. Don't let Mr. Market be the boss of you. Second, think for yourself. Do your own homework and trust your own conclusions. And third, always insist on that margin of safety.
And that really leaves us with a final challenge from Graham. It's almost like a personal declaration. Are you willing to say this to yourself? Are you ready to take control, to think for yourself, and to finally stop letting the moods of a crowd dictate your financial life? Because that is what it means to be an intelligent investor.